Hello and welcome. My name is Benoit Padiquet and I'm the founder and lead portfolio manager here at Exponent Investment Management. Thank you very much for taking the time to listen to the video today. What we're going to talk about today is the first quarter of 2019 quarterly review. And in one sentence, this quarter's performance can be summed up as brought to you by the central banks around the world. Three key drivers or three important points to remember for this first quarter of 2019. Number one, interest rates fell in the US and around the world, and these bond yields have been falling since the beginning of 2019. Other point, second point to remember, the yield curve inverted. What is yield curve inversion? We will cover that in depth later in the presentation, but it's important to remember that short-term interest rates are higher than longer-dated maturities. Most recessions have been preceded by an inverted yield curve, but we're not ready here at Exponent to call an imminent recession, as not all yield curve inversions have led to a recession. We've had a dramatic strong uptrend in the first quarter of 2018. Is that a new beginning, or really just a rebound from the terrible 2018? We'll have a look at that. And it's important to remember that when we have these strong downdrafts and then rebounds, investors tend to travel in crowds. It doesn't mean that the consensus view is correct. So was the consensus correct at the end of 2018, or now the crowd's correct? It's important to make that distinction. Let's look at the performance. Well, the first column is the performance for the first quarter of 2019, and the last column is the performance of the fourth quarter and last quarter of 2018. They're a mirror image of each other. We had a very strong performance across all asset classes, and obviously a very difficult performance in the fourth quarter of 2018. The one-year performance for all of these asset classes, whether it's the Canadian market, the US market, the technology market, or the European and emerging markets, we see still good positive numbers on the one-year basis, but we're still seeing Europe and the emerging markets lagging, and some might say that there's still value in those lagging markets. If we look specifically at the Canadian market, a price chart provided by Bloomberg, and this indent here is the first quarter of 2019. So we see the downdraft really starting in the middle of 2018 all the way down and bottoming up at the end of 2018, and then we see this dramatic rebound. We're seeing also we're at the levels, if you will, of 2018 and the end of 2017. If we look at the Canadian economy, we're seeing some muted growth. We posted 1.8%. The expectations for more or less in the middle of the range between 3% and 0.7%. So the growth is not great, but it's still positive, and we're seeing some interesting numbers where government consumption is expected to come in pretty strong and then drop off and be cut in half later on in the years. The probability of recession is an interesting gauge. Really what you want to look for from quarter to quarter is the change in said probability measure. So 20% is certainly not something to be overly concerned about. If we look at the Canadian corporate profits, we're seeing some strong growth for the next 12 months as expectation, and if we look out 1 and 2 years out from those periods, we're really expecting some deceleration in profits. Cash flows is still expected to go up significantly, as is debt, which is a number that has us concerned. Really, this growth should be predicated or understood by the fact that the oil and gas sector, and to a lesser extent other commodity sectors, have really rebounded, and so this growth in earnings and cash flow and even in debt has really been influenced by those commodity sectors rebounding. Our favorite three-pane chart, again provided by Bloomberg. The top part is the S&P TSX price chart going back 5 years. We're seeing that we're still around the levels last seen in 2014. So one could say that the past 5 years in Canada has been a lot of work, but really no real progression forward. We had the slide and the downdraft in oil prices and the rebound, and then from there we flatlined for a while and then increases in 2018, and then had the dramatic drop on the back of the expectation for higher interest rates. Since the narrative has changed to low and possibly lower interest rates, we had a dramatic rebound in prices up here in Canada. The PE ratio, or what the PE ratio being what investors are willing to pay for each dollar of earnings, has compressed significantly since 2016, really on the fact that prices have gone nowhere and interest rates have risen. The PE ratio really has been compressed, really on the back of the fact that the prices have gone nowhere, really have been in a range between 14 and 16,000 on the S&P TSX, and we've had a significant growth in earnings, so it follows that the PE ratio has been compressed. That could be explained, in my opinion, personally, on the fact that there's been less appetite for Canadian stocks on the part of international investors, and you can also see that in the fact that for roughly the same period of time, the Canadian currency has been stuck at 75 cents to the US dollar. If we look at the market leadership, this quarter was a strong upturn, so that's a risk-on quarter, so obviously the more aggressive or risky sectors, such as the TSX healthcare sector, which is unlike in the US where we're thinking pharmaceuticals, up here in Canada, the TSX healthcare sector is really made up of the cannabis sector. We can see here from the individual names that really most of the usual suspects of the cannabis sector have had a really, really strong quarter. Some of the laggards are interesting. The paper producers, SNC-Lavalin, which is mired in a political scandal, and in Meg Energy, which was a strong performer really in 2017 and 2018, is an interesting, finally, give back, if you will, in terms of performance. If we turn our attention to the US market, we've had, unlike the Canadian chart, which is really just stagnating, this US market, the markets have been on fire really since the first quarter of 2016. The narrative is the same of late, both in Canada and the US, where we saw, starting really in the summer of 2018, a narrative to a more hawkish stance or rising interest rates into 2018 and 2019, and beyond. And that narrative really changed as the economic numbers started to come in and they were softer than expected. And the central banks, the US Fed, has changed its narrative, if you will, or stance to to low, if not lower, according to some pundits, interest rates. This indent here is just this price performance for the first quarter of 2019, and we see just how dramatic and strong the uptrend on was. Really, it was in one-way direction, up. When we look at the economy, the U.S. economy posted 2.9% in 2018, which is a very strong number, especially when you take the size of the U.S. economy into account. All the numbers in 2018 were positive. Exports were strong. Interesting because we're in talks of trade war. We're also in talks of we're in the middle of a really strong U.S. dollar, and so making U.S. exports more expensive to the world, and a strong imports as well. So that all these numbers show a good, healthy economy, economic activity, and the CPI, or measure of inflation, is around the 2% number, which is something to appreciate. Numbers around over 3 and 4 gets the central banks worried, and that's really what has changed their stance, is they were expecting higher interest rates to come in, or higher CPI numbers to come in, and they just simply haven't. The probability of recession is in the 25% range. Again, you want to look at the trend of this number, not necessarily the absolute print, and it's something to look forward, or to look at on a go-forward basis. Corporate profits, if the economy is doing well, companies are doing well as well. So we're seeing 13% expectation for the next 12 months, dividends to go up. We're all looking at basically the main measures in the double digits. Still worried about this debt number. Valuation perspective, still the markets, despite its strong uptrend, the valuations, if we're looking 12 months out or even 2 and 3 years out, we're really looking at a healthy valuation perspective. So the issue is the valuation is predicated, or the low valuations or attractive valuations is really predicated on future growth. This future growth needs to come in order to make the U.S. market viable from a valuation perspective. If we look at valuation, this is what we mean. We've had a price appreciation over the past 5 years. This is the S&P 500's price appreciation chart. At the end of the quarter, we closed at 2873. We had this downdraft slightly down to 2500, and we're effectively back to where we were. Earnings are growing up nicely, so if you have, if your price levels are really back to early 2018, so you have a retracement of or flatlining for the past 18 months and growing earnings, it only follows that your earnings ratio or PE ratio has come down dramatically. We can have arguments as to whether or not these numbers are low or lower or should be higher or lower, but the fact remains that we have positive earnings growth, really somewhat of a flatlining 18-month number, which makes a valuation of the S&P 500 historically, if we look in the past 5 years anyway, around the 18 mark has pretty good value. The market leaders, well, it's sort of a mishmash of sectors and names. Obviously the tech names are still on the top of the charts. The more defensive name like the food retailers, the healthcare index is obviously off this quarter. Only makes sense because when it's the risk on quarter, the more stable and slower growing sectors are put aside. Chipotle is an interesting story. It made the silver medal of the performance of the S&P 500 for this quarter. However, this chart doesn't tell the whole story. Chipotle peaked in 2015 at $754, and then through operational issues and a few health scares that led to slower growth, the stock lost over 66% of its value and bottoming early in 2018 at $255. It since has rebounded. Obviously, this quarter had a very strong performance, and basically most of that performance has been this quarter. At the end of March, CMG or Chipotle closed at $710. So oftentimes when you see these numbers, you start to wonder, why am I not here? The real reason is you should have bought Chipotle back in early 2015 or 2018 when no one wanted it. Alternatively, some of the names down here like Kraft, CVS, and Newell, Cigna, Abvai, CME Group, these were all stalwarts, slow and steady, decent valuation, in many cases very nice dividends, and they're just made up of they are hitting a snag, if you will, operationally, or the sector is out of favor, so a lot of these names are now in the laggards. A lot of these names I wouldn't expect to stay in the laggards for very long. From a sector perspective, on the laggards and the top performers, it really fits with what happened this quarter. Risk on, so they're less risky sectors didn't do as well as the riskier sectors. If we take a peek at the international markets, emerging markets on the top, these are ETFs, EEV and IEV, both trade in New York. We're really seeing sort of a downdraft and then a slight uptick. The reason why the uptick is not as strong is because these ETFs are trading in New York and they're based on international currencies, and being the fact that the US dollar has done well has muted this rebound a little bit. We would safe to be saying that emerging markets react negatively to US dollars. That is, when the US dollar increases, oftentimes the emerging markets will either do nothing or sometimes fade a little bit. And like in this case, where we saw 20% drop in emerging markets for all of 2018. And the same can be said for, even worse, in Europe. And so should the US dollar start fading, it would follow that these two ETFs and these two markets would be strong performers, simply on the basis of currency. If we look at the currency specifically, I said earlier on that the appetite from international investors has not been great for Canadian markets. We can see it here in the dollar. We see the downdraft as the price of a barrel of oil has fallen. We haven't seen, even though the price of the barrel of oil has rebounded to low 60s from sub 40s, we haven't seen the currency match these gains. The only way to explain it is by the fact that the appetite from an international investment community has been muted for Canadian securities and thus Canadian currencies. Really, the narrative in Canada has changed from a great place to do business to a tough place to do business. Over in Europe, the euro has been also in the trading range since 2015, and the pound obviously in the throes of the Brexit narrative, or even some would say drama. It's safe to say that the US dollar has been strong against most currencies, including two of the world's largest currencies, and our beloved loonie. If we look at interest rates, this is really where the second story really lied. So I will get you to focus on the white lines, which represents the corporate bond yields, or yield curve, I should say, where we have the yields going down the y-axis and the maturities down the x-axis. And irregular shaped yield curves look like this. So this is the Canadian corporate curve, very normal looking. The blue line, the dashed blue line, was where rates were a year ago, and we see sort of a dramatic drop on the longer maturities, 15 plus, really 5 years and out, the yields have dropped, and we see in the shorter end maturities, we saw a rise in interest rates. On the Canadian curve, this curve looks just wonky, and this is what has many pundits worried. We are seeing shorter end maturities being higher yielding than longer dated maturities. So lots of PHEs have been earned on whether you should look at the 3-month versus 10-year rate, or whether it's the 1-year rate versus the 10 or the 20s. I'm not here to debate them, but let's just say this curve looks wonky. Why are we worried about this? It's fairly simple. Banks tend to fund themselves by taking in deposits. Most of those deposits are shorter term in nature, and then they make out loans out into the 5-year area, or they can go out into the bond market and make some investments. So this shape does not lead to great lending activity. Banks effectively losing money as their cost of funds is larger than what their returns are on their loans. Central banks are still very active in the bond market, so I wouldn't really look at this curve necessarily as a precursor to the recession. I'd still be looking at the corporate curve, which still looks healthy. Should these two curves start looking flat, and if not negative, then yes, I would start ringing the alarm bells from a imminent recession perspective. In the US, the curve is steeper on the corporate side. We're still seeing the same types of shape where we're seeing the blue line, higher a year ago. The rates were higher than they are today, slightly lower on the long end, but that's sort of normal where you have some of these little shifts. The belly of the curve, sort of the 5 to 10-year dramatic drop, and then we still have the shorter end of the curve where we had a rise in interest rates. The US curve on the government side still looks kind of wonky, similar to Canada, but the rise on the short-term interest rates has been even more dramatic in the US than in Canada. So really something to look at. Many pundits associate an inverted yield curve to recession. As I said earlier, really you want to look at both the government curve and the corporate curve. If we look at the options market, what's it telling us? Well, we had the spike in the VIX. The VIX is the measure of the 30-day volatility or up and down movement of the S&P 500. So obviously as markets drop and there's a lot more activity and up and down, the VIX tends to go up. We've had a dramatic drop in the VIX, which is interesting, as I would expect it to be in single digits like we saw in 2017. It is not the case. I consider VIX around 15, even all the way up to 20 as sort of within the average range. We're below that, but we're still not in the same single digits. If you've got option selling strategies, whether it's selling puts or calls, 15 to 20 is ideal, as I've said, but 12 is still a nice place to make some money. So what are the conclusions? Well, the markets recovered from their Q4 slide. Is it predicated? It's certainly predicated on central banks, or the expectation of central banks keeping their interest rates low, if not lowering them. Corporate profits continue to be healthy in the US. We would expect margin pressures both from full employment situations and last year's tax cuts as they move forward in time here. We're going to have making the one-year number comparisons much more difficult. Valuations continue to be reasonable, but what's important is that they're really, really predicated on continued growth in the US. Canada, the valuations are very weak, very cheap, and let's be honest, international investors don't have high hopes for the Canadian corporate sector. We're starting to see some pocket of speculation. You're starting to see these tech unicorns come to market, and their IPOs are doing very well. So that's a symptom of a risk-on type of attitude in the markets. From a portfolio perspective, we don't expect to be very active, both either on the buy side or the sell side this quarter. Valuations are good. We deployed some capital at the end of last year. We had a lot of cash towards the end of the fourth quarter of 2018, which we deployed. We still have some cash, and so that leads us I would say, somewhat neutral. If we see prices coming in on certain names that we have our eye on, we'll certainly be buyers. And we don't really have any names in our portfolio that we're worried about from a valuation perspective. Those, we had a couple names where we were worried and we sold them during the quarter, but on a go forward basis, I really don't expect a whole lot of activity. Thank you very much for watching. If you have any questions about this video or any other investment or financial planning questions, do not hesitate to contact us at info@exponent.com. Thank you very much for watching and have a great day.